my version of the equity risk premium, I'm basically using the CAPE earnings yield, so average 10-year trailing earnings divided by price. I think that it's best to use that rather than forward earnings or trailing earnings, because they're still, I think, still quite distorted by the shock impact of the pandemic. I don't think that they're necessarily representative. Whereas the P10 or the CAPE gives you a bit more of a stable anchor. So anyway, takes that minus the 10-year Treasury yield, so the current yield, and minus 10-year CAGR or compound annual growth rate of CPI, so the 10-year inflation rate. And that's what we end up with there. So it did go to cheap levels, pretty attractive levels in March last year, and has since come back down to really pre-crash levels. But still not yet down to 2018 levels, where we had that situation where yields rose and basically triggered the market to go into a bit of a pretty decent correction then actually. And this chart, I think, is probably the best way to sort of frame it. So if you look at the black line there, that's absolute valuations, which, whatever way you cut it, obviously the trailing and forward PEs look potentially a little bit more expensive than the true signal might be. But even the PE10 is definitely elevated, or the CAPE is definitely expensive zone. I think it's pretty clear cut that absolute valuations are expensive, but the equity risk premium, so I've been showing it here inverted. So it did get down to 1 standard deviation cheap there, actually below. Now it's come up to neutral following both market movements and bond yields, the move up in bond yields. So we're actually neutral there now. If we get another 50 to 100 basis points up in US 10-year, that'll take us up into the expensive zone, and basically brings us to that situation that we got to in late 2018, where both the equity risk premium and absolute valuations were on the expensive side. So I think that if we saw bond yields going up too high like that to trigger or to move the equity risk premium over into expensive zone, then that really does increase the risk drastically of correction. I still think that to get to an end cycle view, to a bear market view, that we do need to start to see the Fed actually move out, or for it to be imminent that the Fed moves away from easing to outright tightening. I think that we need to see that to get structurally defensive, but that we could definitely see correction risk rising as bond yields edge higher. The counter to that would be if inflation moved up high enough to sort of offset the move in yields. And then I guess the other counter argument is that, well, if bond yields are going higher, then it's because the economy is getting better. And I think that argument probably stands more so for the value or the old cyclical sectors, so energy, financials, materials, industrials, probably maybe less so for tech, and probably less so for defensives as well. So and given that the US market is heavy into tech and very light on old cyclicals, it leaves the US market quite vulnerable. So that's the long answer is that if yields go up above towards and above 2%, then correction risk definitely rises. Basically probability goes up with every basis point after that. I would just mention these in passing. I'm going to address the bottom left chart in the next weekly report, just because, so these are kind of a quantitative, mostly quantitative outputs. There are some qualitative inputs around growth, but the reason why it's so negative for the US is basically valuations. So it's assuming mean reversion. and it's using absolute valuations there. So, I mean, is it going to be 100% accurate? Hard to say. Is it gonna does it reflect to us how high valuations are and how that is increasingly a hurdle? Yes, I think so. I think that's the key takeaway there. The other thing that's interesting too there is just the sort of forward-looking equity risk premium there. So did actually get very high during March last year and then has come down into the negatives. I mean, you can see it on the chart there. Equity is expected to deliver a more negative return than treasuries in real terms. So, yeah. And again, I think with these capital market assumptions, it's always useful to look at the relativities there too. But I think you know the split between growth assets is at this time, given these dynamics that I talked about, is I think it makes more sense to be more active within that. So um, getting a bit more granular in terms of regions, countries, and also thinking about commodity exposure versus equity exposure. So that's basically it for that topic.